Now, the next question is from Aaron West, and Aaron asks, can we expect any sundown provisions on bailout legislation as an exit strategy for the government? Are they necessary to keep the government from not backing out after a year or two of stabilization? Or will the government take over, develop its own inertia, and never exit this market? Well, I will add first in my case, the government finds it much easier to start programs than ever to get out of them. But I think what we talked about earlier with the resolution trust was a pretty good model, where it's a defined thing where you accept some of these things, you move through, and then dispose of in a fairly orderly fashion. And if we stay in that direction, I think this can be fairly short. However, if what we've stepped back and see is we've entered a process whereby, okay, now we're going to have another resolution trust corporation kind of thing, and we're going to have one after another of these kinds of things going forward, we could be into a different problem. Right. In other words, we're going to have series of crisis to crisis to crisis. I mean, I can tell you I've seen other people say things about raising concerns about Fannie Mae and Freddie Mac, government-sponsored enterprises, for a long time, and it's just now that that crisis has hit and become visible to most of the American public. It becomes a topic of, research at finance and economics seminars, papers in the professional journals, meetings, and so on. Everybody else says, oh, it's just ivory tower, folks just talking to each other. But down here, we think Fannie and Freddie are working really well, extending credit for mortgages and helping the American family afford a house. Well, sometimes it's not just that. Sometimes it really is problems building and that we all have to deal with later. John, Beverly, do you want to add anything to that point, or have I pretty well
No, I agree. I think some of the debate in Congress even today was talking about, at least for part of the liquidation enterprise, whatever they call that, having some type of life, whether it's a 2-year life, that's 1 year that was bandied around today. So I think they are, in that aspect of it, talking about some finite life for whatever the entity is that liquidates all these properties.
Sure. Okay. Let's see. Jasmine Saxon. How about letting the shareholders decide the compensation of the executives like Aflac did? Well, it's an interesting proposal. Can either of you shed a little more light on what Aflac did with their shareholders in approving the executive compensation package?
Gosh, I don't know any details of that. I think I've just, in general.
If I saw this correctly, and this is subject to correction for all the folks out there, that the Aflac executive team, particularly the CEO, said, here's my compensation package. You guys can vote it up or down.
Okay.
And I think and this is subject to correction, but I think I remember saying that, in fact, the shareholders approved that. Now, that's an interesting kind of thing. That's a greater degree of transparency and participation on the part of shareholders than most corporations have. I don't happen to think that would make much of an effect on this kind of problem that we've seen. Publicity-wise, it'd be much better. But as a material cause of the financial problems we have, I just don't happen to think that executive compensation's got much to do with that. So I don't care what mechanism you use to determine it. I don't think it matters very much. Do either of you guys disagree with me on that?
Well, I mean, there's certainly been some concern from activist shareholders about the levels of compensation, and that's one way that Aflac could address it. But again, I don't think that's the major problem with what happened in the credit markets, barring the fact that there were, significant compensation driven by CDOs and credit default swaps. I mean, certainly, but
I like to look at to the value they add, and I know Dan and Beverly always heard me say, the day that we can get all of you to come and pay $60 a ticket for me to do a finance lecture in our football stadium, and 86,000 of you do that, then I darn well better be paid what the football coach is paid. I mean, I think that's only fair.
Sure.
I don't think I'll hold my breath waiting for 86,000 people to.
It hasn't happened yet.
It hasn't happened yet,
us, right?
But maybe we'll have an outpouring of support after this for that. So I think, I always look to what someone makes relative to the value they add for the shareholders. Just looking down at the questions, one comment is, if they're being paid too much and you don't like it, can't you sell your shares? Absolutely. Right. Now, and like Beverly mentioned, though, we do have a lot of activist shareholders, like CalPERS, the California Public Employees Retirement System. Very large, very active. They are large enough as a pension fund to go in and influence corporate policy. So there are activists out there who do these things and try
Monitors
to monitor it and try to change where they think it's excessive.
Yeah, absolutely. And I think executive compensation is a great additional topic, perhaps, that we can come back and discuss a little bit. I know, John, you and I have done some work on that, and Beverly and others have done some things. So it is a hot topic. It is one about which people care a great deal. But again, I don't think it has too much of a contribution to the current financial problems. I'm tempted to skip over the second question on the monitor right now, because it says, question for Dr. Gropper: if it were your responsibility to turn this economy around, what kind of actions would you take? It is, of course, much easier for me to sit here and criticize what other people are doing than to actually say what I would do instead. But in part, I think we do, philosophically and practically, these questions come together, because philosophically, I'd say once you start down the road that says you're going to try to use Federal Reserve monetary policy to actively stabilize the economy, keep inflation low, pay attention to credit markets, being worried about unemployment, housing starts, and all the rest, history tells us we get into these kind of problems. So you cannot pursue all of those goals with monetary policy. The best goal for monetary policy, in my view, is price stability, and to try to get out of these short-term modifications that I think lead us to where we are now. Now, does that mean if faced with the practical concerns that people, Bernanke and the other members of the Board of Governors and their advisors faced over the last 2 weeks, would I do anything differently? I can't say that I would, but it's rather different to sit here on a stage and talk about it rather than sit there and say, okay, trillions of dollars and people working all around the world are dependent on your decisions. So in fairness to those folks, I'd say, well, I'd like to not be in that position in the first place and really have sort of set the thing where you say, nope, we are going to pursue a stable monetary policy where we're letting the money supply grow at a rather constant rate and let the credit markets take care of themselves. We are so deeply invested with all of those things that it's hard to sort of back off and say, well, yeah, that's fine, and no, we're just going to keep our eyes focused straight ahead and not worry about these other kinds of things. Nonetheless, I think it's very difficult when you start doing that, and again, picking winners and losers. So in fairness to the question, I wouldn't try to pick, Bear Stearns, is a winner, Lehman Brothers is a loser, AIG is a winner. Try to stay out of that.
But you put Beverly in as chairman of the Fed.
I would hire Beverly and other people smarter than me to go do these jobs. That's absolutely right. Next question, Jim Barth in his Fox News interview. And for those of you who haven't met him, Jim Barth is our louder eminent scholar in finance who splits his time between Auburn University and the Milken Institute. Jim Barth in his Fox News interview mentioned that we let interest rates stay too low for too long. Would higher interest rates be such a bad thing if, as a result, savings earn more interest? Would that not spur more savings contributions in these financial markets? Colleagues?
Yes. Higher rates will pull more money in, but again, think about it. Let's just take a bank. You bring money in, you make your money by lending at a higher rate. So as you bring more money in, though, will you be able to lend at that higher rate? What are you going to do with the funds? You see what we're saying? So you have to look at what they can earn, and as a bank, the way you make money is on your interest margin. You have to be earning more on your loan portfolio than you are paying out on your deposit. Right. So you have to look at both sides of it. So sure, higher rates would pull it in. Which does raise a point. Now's a tough time to be a retiree on a fixed income.
Absolutely, my mother. Yeah.
Yeah, because I'm sure everyone out there knows someone who may be relying on certificates of deposit or bond funds, and their income has gone down pretty dramatically, I suspect, over the last
real income, the purchasing power of those folks especially is going down, and it's going to get worse if inflation keeps picking up.
That's right. So low rates are good if you're a borrower, but they're bad if you're savers.
Well, and I think I tend to agree with what Michael Jones said that Jim Barth had stated there. And again, that was the point I was trying to make earlier when it said the Federal Reserve had pushed those interest rates down. And keep in mind, it's not just nominal interest rates, it is real interest rates that matter. And so right now, the Federal Reserve is being extraordinarily expansionary with short-term rates because we've got the Fed funds target rate, I believe, at 2%.
Right.
We've got inflation, even just as measured by the core inflation rate, excluding food and fuel, that's higher than that. So we have negative real interest rates, which means the Federal Reserve is supplying about as much credit as it can.
Yes.
That inevitably leads to inflation, and we've already got inflation building up from 1 and 2% to 3 and 4 and 5%. So I'm afraid that we're going to see more of that down the road. Okay? All right. Let's see. Christopher Baker has submitted another question. And I see Bob Cornelius has successfully got in. So, Bob, I'm glad you've been able to join us here, too. But first, from Christopher Baker, given the $700 billion, quote, bailout and the increases to the debt limit to more than $11 trillion, what do you think will be the impact to the value of the dollar?
We saw that today. The dollar had its largest one-day decline against the euro, 2%. Again, the expectation is now that there may be another reduction in the U.S. interest rates. We're already low versus other countries, and so that would put downward pressure on the dollar. The expectation that the dollar was going to go back, and I was actually listening to a newscast that was talking about the spike in gas prices, oil prices today. We're up 15-16%, $22 a barrel, somewhere in that range. So again, what's happening is when the dollar had when gas prices went down, the dollar was actually gaining some strength back up against the euro and the pound. We've seen that change again as expectations, uncertainty in the financial markets, expectations that now the Fed may act to print money, or increase the money supply and lower interest rates further. Yeah. And again, that is an issue for the dollar.
Sure, and this causes a decline in the value of the dollar because the euro and other world currencies are not being expanded as fast, so their value is rising relative to the dollar.
And they have more room to move their interest rates. They're already higher than ours. Yeah.
Yeah. Okay. Our last question will come up next, but before we do that, I want to thank my colleagues, John Jahera and Beverly Marshall, for being here with us tonight. It's been an interesting experience for us and hopefully a rewarding one for all of our students out there. Bob Cornelius, who's an EMBA alum, asks, concerning the new regulation that will come out of this crisis, is there a chance that an overregulation could be protectionist, i.e. similar to how the Smoot-Hawley Tariff Act did in the 30s? John?
Well, there's always a potential for that. Again, my speculation is we're going to enter at least some period of overregulation. How long that lasts, whether it's 3, 5, or more years, but both parties seem to be posturing to add regulation. But again, it goes back to what do politicians do? They pass laws, create regulations. I mean, that's their job. That's what we send them to Washington. Well, maybe we don't send them to Washington to do, but they think we do. So I think we can expect, with the posturing both parties have right now, is we've got to do something to fix this, and the key is we've got to enact more regulatory oversight. So this could well happen. How long it lasts, hopefully it won't last too many years, and there'll be an easing back so that we can get back to these unfettered markets. Very similar to post-Enron. Yes, you got to restore investor confidence. One way of doing that is, again, to create more regulation. Financial crisis, government action, and a political season are not a recipe for economic success, at least not in my view. So hopefully we won't have anything that replicates the disaster that was the Smoot-Hawley Tariff Act that helped turn the recession into the Great Depression, at least contributed to it back in the 30s. Well, thank you folks very much for being here tonight, and thank you all for joining us. And that's all for tonight here from Auburn University. Thank you. Thank you.